The sixth step to financial freedom is all about taking advantage of the opportunity of making money from money. So what we're talking about here is investing, putting your money that you've already built up to work to get even more money. So that's what we're going to be talking through today. So let's jump in. Hi, my name is James Corsia and thank you for joining us today. And welcome to the Money Paradox podcast. And today, that's right, we're going to be going through the sixth step to financial freedom of our 7 steps, all following the mnemonic paradox. So when we talk about the opportunity of making money, when we talk about investing, that's because for a lot of people, they focus on building their wealth through saving and accumulating that money. And that's great, and that is an important part. But if you're not taking advantage of this opportunity of making money from that, you are just going to become financially secure and not financially free. And the reason is because if you build up money through savings and you don't do anything with it, let's say you put it in a bank and you're either getting no interest or 1 or 2%, then the interest you're getting is lower than inflation. So effectively, over time, you are losing money. So think about that. When you're not investing, you're actually losing money from your money. You're not staying the same, you're actually losing money. Now, this is an important thing to bear in mind because by doing nothing over time, you are wearing down the value of the money that you already have. The other thing is that by not investing, you're effectively still investing. You're just investing in nothing. You're investing in just a bank, all right? It's still a vesting decision. So whatever you do, you are essentially investing. It just depends on in what respect. Now that might sound a little bit silly, but really it is. You're taking a decision on all the various opportunities and you've made the decision to do nothing or to put it in a bank and get 1 or 2% interest. Now the reason why it is so important to take advantage of this area to become financially free rather than financially secure is that by this period of growth of your funds, and over time it actually becomes exponential. And that's because when you start to invest money, you get a return on that exceeds inflation, and you're able to build that wealth over time in addition to what you're saving and adding to the pot. So if you think about it, if you didn't get a return on your money, think about it like this, as you save money, your money is just going to build up like that. But if you invest it, that money that you're saving already, that money at each stage can build a return on top of it, right? A bit on top. And as you get more, the investment returns you get are even more. So you get even more, investment returns become even more. It's the point where it expands even more. So that linear curve starts to look more like an exponential curve. The other bit is that money you're making from an investment return, right? So money from the money. If you put that in, you reinvest that exponential curve becomes even steeper because the returns you're getting that you're adding on to your savings as you progress. On top of that, you're getting a return from your returns. So you're getting the money you're saving, the returns you get from your investment, and then you're getting the returns from the returns on your investments. And that effectively spirals upwards in a positive place. And you take advantage of this really important concept of compounding. I've talked about that in previous videos. So if you don't know too much about that area, go check it out. But essentially what it is taking advantage of this exponential curve. At first, it's kind of slow and you don't see much, but in time, that curve starts to get steeper and steeper and steeper until the kinds of money that you're making are much bigger than the kind of numbers that you're looking at right now. And that is how you get, that is how you're able to accelerate your path to financial freedom and actually make it possible. Okay, so first point I want to make is you cannot reasonably become financially free unless you take advantage of this opportunity. The other area is obviously by just earning more money, building up wealth by earning it. But even then, if you think about it, the way you build a business is kind of like investing. If you just did the same amount, then it would build up fairly slowly. But if you invest your time, you build it, you get this nice exponential growth. And that is how you get the kind of numbers that allow you to become financially free. Okay, so first point. Second point I want to cover is that if you're sitting there and you're thinking, how do I become financially free? I mean, not how do I become financially free? How do I start investing? I don't know what to do. It's not an area I'm very good at. I don't know too much about. I don't know where you are in the journey around investing. But the key thing I would say is I'll go through how to invest and all the various factors in another video. But really, at the essence of all of this is you need to find a source of information that you can trust. Now, the reason why I say that is because there is a lot of information out there, many different areas. You can go on various news articles, different people, different businesses that will all be wanting to give you investment advice in very different respects. But the key point is two things, right? Essentially, you want to take information from a place that you trust, high believability. And that's because without that, you might be getting information on how to invest, but how do you know that is the best course of action? So that's really made up of two areas. The first one is, are they telling the truth? Okay, because a lot of people might know how to invest or might know how to get a strong return from investing money, but what they're telling you, is it in line with what they know? And a good way to establish this is through concept of conflict of interest or self-interest, right? So if you're getting that information from somebody that benefits from you making the investment in terms of what they're recommending, then you need to tread very carefully, because what they have a big interest in you committing to the thing they are recommending, right? Now, some people might well be, telling the complete honest truth in that environment, but a lot of the times they aren't, and that's because they are naturally going to change how they are telling you certain things and opting to tell you certain things and opting to not tell you other things to encourage you to invest in the particular thing that makes them money. Okay, so bear that in mind. Anything where their interest and your interest is different, then you've got to be careful of the truth piece, right? So always think to yourself, how do I know this person is telling the truth? How can I believe? How can I know that I can believe what this person is saying, right? And the second thing is about respect. Okay, so this person, you may know 100% this person is telling the truth. Everything this person says is always true. It's just how they are. They come from a place of high integrity and always do that. But if that person fundamentally doesn't have a strong skill set in that area, then they might be telling the truth, but do they just simply not have good knowledge in that area? Do they simply not know the best way to invest or can give you sound investment advice? So think about it. What's a good example? Take the example of health. If you talk to your friends, family, whoever, people you know at work about losing weight, for example, I can imagine that almost everyone will have a view on that, right? They'll all want to give you their thoughts on how to lose weight and all the various things they've read or learned or think that works. But then of all those people that give you those thoughts, how many of them truly are good in that area? How many of those are actually in good shape themselves? How many of those people have consistently been able to lose weight themselves? How many of those people have actually taken action on the things that they're telling you? I would say a much smaller portion, right? So it's the same in the area of money, right? So if you're seeking to gain more information in this area and gain more knowledge and thoughts on how to improve in the area of investing, then you want to be speaking to people that you know have done well in this area before. How do you know? Have they consistently made money through investing in the past? Have they actually tried themselves the ideas and the practices that they're telling you about? Okay. Do they know other people in that space that have been doing similar things and they know it's worked for them? These kind of things. If you know that, that is a strong indicator that what they're telling you has a high level of respect. Okay? And if you combine that truth or trust and respect together, you get this believability concept, right? If the believability is high for somebody in the area of investing, you want to be directing your attention to that. It's not about going and speaking to lots and lots of different people all about this area to try and gain as much information as possible. It's finding maybe just a few people, or maybe even one or two people that have a high believability in this area. Because in the world of investing, there is a lot of information, it all conflicts. And when you have the source of information that you can believe, then you can start to trust what these people are saying and then be able to confidently apply that to your own life, bearing in mind your own situation. Okay? So that is the second piece I want to talk through. The third piece and final piece is all around, if you're starting on this journey, right, and you don't know what that best kind of first step is around investing, okay, or like a type of approach to take. The way I recommend it is an evergreen approach. So if you think about trees, right, if you think about evergreen trees, they are trees that stay green all year round, all 4 seasons. And you want to be taking an investment approach that's like that reliably does well, may not be, it may not blossom into huge flowers kind of 1 season a month, but every season it's green. It does well. It's positive. It's in, it's flourishing. And that's the kind of investment approach you want to take. Because in this day and age, there are different environments, different stages within an economy. You can have economy that's growing, economy that's going down. You could have inflationary, deflationary. You could have times where there is high global instability or low global instability. Certain countries might be doing better than others. The world is constantly changing and we're constantly in different situations. And all of these different situations mean that certain investments will do well or not so well in each of these environments. Okay, so you want to be focusing on an investment approach that, regardless of the situation, within a reasonable period of time, it's going up. Now that might sound kind of easier said than done, but at least if you're coming from that perspective, when you're looking to decide on how you want to invest, then you'll start to find approaches that fit that mold, right? If you've got an outcome and a type of approach that you want to be pursuing, then you have something to work towards, to compare to, right? Rather than just saying, I want to invest, right? If you don't have a particular kind of almost type of approach that you want to seek to achieve, then what will happen is you'll naturally just look for any type of investment, and that type of investment may not fit with ultimately what you want from life. So, for example, a couple of good examples that I see people talk about a lot are, one, cryptocurrency. Now, cryptocurrency is a very controversial subject and a topic for another day. I mean, I personally invest in cryptocurrency and a number of cryptocurrencies, and I've done well from it. But it's very volatile, right? And the confidence of what's going to happen in the future is very low, because it's a very new thing to invest in. So if you're very early on in the investment approach, right, then cryptocurrency is definitely not a good place to start, because it's hugely variable, it's not reliable, there's no clear dividend or return on it, there's no quantified kind of value to it compared to a lot of the value at the moment is very speculative, right? So if you move into something like that, and certainly a big portion of your money, then what happens is the overall wealth that you have can vary hugely, right? And that movement and stress and this lack of clarity on the future can cause you to kind of move in different directions that you didn't necessarily intend to when you first started. So if you do decide to invest in things that are a bit more, much more volatile, much more kind of speculative, like cryptocurrency, it needs to be either nothing initially if you're very new to investing, or a small part of your investment fund, maximum 5%. Okay. Another area is the stock market. Now, a lot of people are big into the stock market, and that is because, generally speaking, it is proven historically to be the highest returning asset class. That just means a type of thing that you can invest in. Now, that's true, generally speaking, but with the stock market in particular, what we talk about, the main stock market like the FTSE 100 or S&P 500, don't worry if you don't know what those mean, but essentially just means a group of stocks within the market that represents the stock market as a whole. If you look at those kind of markets, again, the volatility is very, very big. So, for example, in 2008, the stock market crashed by 50%. 2002, 2003, again, almost 50%. So if you're investing in something like that, and then a year later it drops that kind of much, then that has a huge impact on your financial situation, right? Now, ultimately, if you are going to be saving for 30, 40 years and then retire at that point, then it's not so much a big deal, because that 50% drop naturally over time will go back up if you base it on what happened in the past. But the reality of that, of seeing that kind of drop, the emotional impact, the reality of the fact that not everybody wants to retire in 30, 40 years. I'm a big advocate of early retirement, right? Being able to retire as quickly as possible so that you can break the shackles of having to work just for the sake of it and work on what it is that you actually want. If that's what you're pursuing, then all of your money in the stock market can be dangerous, because if you have a big crash, then a huge percentage of your funds, of your money, can drop in a very short period of time. And then you're going to have to wait even longer to build up that kind of wealth to become financially free. All right. So when you're picking something, you want to be looking at an evergreen approach. And in future videos, we'll be talking about some of the different things you need to be kind of thinking about when you decide on what to invest, and the kinds of approaches that represent an evergreen type approach and why they look like that in particular. So I hope you found this video helpful. If you did, please like and subscribe to check out my future videos. If you felt this video would be helpful for other people that you know, please do share that with them, or other videos you think that are powerful. If you think there is some particular content that you'd like me to cover in future, again, let me know. Send me some comments in the space below, and I will look to kind of create some content in those particular areas, because my mission around all of this is to make sure this content is as valuable and relevant to what it is that you're looking for. So that's all for me. I hope you enjoyed this video, and I hope you have a great rest of the day. Take care. Bye-bye.